Hello, everyone, and welcome to Your Finance TV. As we do at the end of every week, we catch up with Jay Pelosky, who you can see on the screen now. But this one's a special one because it's the end of the month. So we're going to have a nice month review. How are you, Jay?
I'm good, Scott. How are you, buddy?
I'm fantastic, especially having you to talk to. Now, the title of your musings this week on the Menden Monthly is Short versus Long-Term Investment Thinking. Now, I think it's a big trap that investors do fall into. And I constantly get questions like this from friends. And I ask them, are you thinking short or long term with your investing? Can you break down how you summarize this to start off your musings?
Sure. As you know, Scott, the monthly is our deep dive, right? We do it at the end of every month, and it's actually the prelude to our updating of our model portfolios, which we'll do next week. So this issue, short versus long-term investment thinking, is about 5,000 words, has over 20 charts and tables from 15 different sources. And we'll reference some of those charts, and perhaps you and your magician buddy Monty can drop them in to the document here or to the video as we move forward. So basically, a number of things have kind of come together in our thinking at TPW Advisory. We talked about narrative speed. I think that was the title of our last monthly, right? That narratives were flipping faster than they ever had been before. And when we wrote about, 2 steps forward, 1 step back, then we talked about no need to chase. So a lot of our thinking has been around this idea of, longer term narratives, rapid changes in investor thinking, markets moving very aggressively from oversold to overbought, back to oversold, and investors basically like contorting themselves, trying to figure out which way they should be moving, right? Should they be buying? Should they be selling? Should they be doing nothing at all? And it's interesting, of course, that amidst all these gyrations, cash has become a very cool thing for investors, right? I was on Bloomberg a week or two ago, and I was asked about cash as a relative opportunity versus other assets. And so to us, cash is a trap. We do not think that it's really an appealing environment to be loaded up in cash. That was last year, right? If you were smart enough to be in cash last year, more power to you. 2023, 2024, in our view, is not the time to be invested in cash. So really, we think about it in a couple of ways. The first is that most money is long-term. Pensions, endowments, 401ks, target date plans, etc. There is, however, a significant amount of money that is managed on a much more short-term, days and weeks, if not minutes and hours, right? And increasingly, that money is managed by machines, right? It's all algorithmically driven. And our view is that unless you have a real edge, the short-term trading part of the business is not for most people. It's hard to make long-term success in that game or that part of the game. But what it does do is it provides liquidity and price discovery for the longer term investor. And that's kind of how we think about things. And we see the current environment where we went from oversold in December, right? December, S&P down 5, overbought at the end of January, S&P up 5, and now at the end of March, beginning of April, back to oversold in a number of conditions. This is really where the opportunity lies for the long-term investor. This is where if you didn't step in December, now you have another chance to step in. And so it's really important in our view, as our long-term thesis starts to play out, we want to do 2 things. The first is we don't want to be shaken out of long-term positions by short-term market gyrations. And the second is that we want to maintain conviction in our longer-term views, even in foggy weather, which was the title of our musings last week. And so that kind of brings it all together as how we're thinking about it from a big picture point of view.
Thanks, Jay. That's a very good breakdown. It reminds me to what tell all the viewers here, like, don't forget to click on subscribe here, because you get great insights like that from Jay and many other people as well. But also what you're going to get is Jay's breakdown for the month. Now, what we do with this is he breaks it down to 5 different sections. And this, we're going to start off with climate. So let's touch on climate there, Jay.
Well, it's a good opportunity, Scott, to remind people that, as a global macro investor, and I've been doing this for 30 plus years, you have to have a framework and a process, right? So the framework is our tripolar world thesis: regional integration, regional deepening in Europe, Asia, and the Americas. Our process is the writing, the musings every Friday, monthly at the end of the month, and then after that deep dive, update the portfolio. But within the monthly, we have the process of what we call our global risk nexus, or GRN. And that looks at climate, economics, politics, policy, and markets. And we do that across the tripolar world, 3 main regions. In that way, we really feel like we can capture all that's going on while not being kind of our attention drawn by whatever the latest little brouhaha is, whether it's the UK pension fund or, Japan's yield curve control adjustment or China's zero COVID. I mean, there's so many things that are flying around the world that if you don't have a process, you really struggle, I think, to be, to be successful.
I do love that financial term, brouhaha.
Yeah. Well, that's probably because it's from your native land, right? And, frankly,
let's move on to climate, though. What are you thinking on climate?
Frankly, not much other than kangaroos, not much else is, right? But no, sorry, no offense. Good beer, good Barbie, and back to climate. Yes. So look, we've talked about this for a couple of years now. We think climate is the single biggest global macro theme of the decade. Full stop. There's nothing like it. There's no other theme where every country in the world is spending money from now through the end of the decade and beyond. And as investors, we believe at TBW Advisory that you have to be fully involved and cognizant of this and participating in it. And this is where the beauty of the ETF space comes in, Scott, because ETFs allow you to take positions across the full spectrum of the climate mitigation chain, right? Ranging from transportation all the way to power generation. So we think of things like carbon, where we have a great chart in the monthly. I think it's chart 8, showing that carbon in Europe just broke above $100 for the first time in its 20-year history. Carbon is a great way to play the long-term theme of climate mitigation in our view. But there's also wind and solar, right? There's nuclear, which we've talked about before, and is another core theme of ours. There's on the transportation side, there's the electric vehicles, et cetera, et cetera. So we think that climate really represents the interplay between the short term and the long term. Many times over the last couple of years, there's been some report or another, and these climate ETFs spike, and then they crash. And so we want to take advantage of those fad-like conditions to sometimes make some money and sometimes buy opportunistically in that space, because we are now moving, importantly, and I think the audience really should pay attention to this. We see that the climate effort is moving from political talking points to industrial scale execution. And both, particularly in the US with the climate provisions from the IRA Act, as well as in Europe, where the Renew EU is focused on climate, all the way to Japan, which is talking about reopening its reactors. For the first time since the Fukushima nuclear accident, Scott, a majority of Japanese are in favor of restarting their nuclear reactors. So things are really happening, and investors and our clients certainly benefit, but investors overall should be really focusing in on climate.
That's very interesting. Thanks for that, Jay. Now, let's move on to economics. Now, it seems like this week there was at least 3 Fed speakers every single day, and markets were moving on it every single time. Talk to me a bit about what your writings are this month on economics.
Well, no surprise to you, Scott, but I'm sure, but perhaps surprising to some of the folks watching, is that our conviction in our no recession call continues to grow. And there were numerous data points. We focus on the data. We don't really focus on Fed speak, to be honest, because again, Fed speak is a perfect driver of short-term trading noise. It's typically not much of a driver towards long-term investment returns. Fed action is, granted, but not Fed speak. So look, we saw a couple of things that kind of reinforce our conviction of no recession. One is a great chart that we have in the monthly, I think it's chart 4 by Deutsche Bank, showing that global manufacturing PMIs have broken back above 50. So that's the expansion level, right? The dividing line between contraction and expansion is 50. We also noted that the composite PMI, so both manufacturing and services, broke back above 50 across Europe, across Japan, and across China this past month. Europe, Japan, and China. Okay, so that's a big slug of the global economy, where the composite PMI, led mainly by services, is breaking back above that 50 level. The US is actually the laggard in this process. So the other thing that we note is that G4, so group of 4, US, Europe, China, and Japan, their central bank liquidity provisioning is expanding. And that, again, is on people focus on the Fed in the US and just the Fed. But no, we live in a global world. Money is fungible. So when PBOC in China and BOJ in Japan are pumping out liquidity, as they are, we have a great chart, I think it's chart 9, showing exactly that, the liquidity really spiking, and particularly in Asia over the last couple of months. That's really constructive for the global economy. And then finally, we look at inflation. And yes, January was a hot month, hot in data and hot in weather. And we think the two are related, right? Warmer weather pulls forward consumption and therefore gives you an illusion of kind of a stronger economy and higher inflation pressures. We think that's going to ebb. And we saw some good work from the folks at Bespoke, who note that if inflation comes in as consensus expects in the next month or two, by the end of this quarter, Q1, inflation will be down to 4.7% year over year, versus a Fed funds rate that by the end of March, early April, is probably going to be close to 5%, 4.8, 4.9%. So we will finally have gotten Fed funds above year over year inflation. And that suggests to us that we're getting close to the end of the Fed tightening cycle. And so for us, last point on this is that we think that the onus is increasingly on the bears to make the case as to what's going to drive another big leg down in the markets. Manufacturing is bottoming, right? Global manufacturing PMI is breaking above 50. Housing in the US is bottoming. Property in China is bottoming. Composite PMIs above 50. Fed approaching the end of its tightening cycle. So I think if I was a bear, I'd be much more concerned if I was bearish than bullish, because I think the time frame is shrinking. And I'll just leave you with 2 data points. The folks over at Barclays, who do a really good job on kind of the industrial outlook, they expect the manufacturing PMI in the US to be about 53 by the end of this year. Okay, bottoming in the middle of the year, Q2, and accelerating. The National Association of Realtors think that housing is bottoming in this quarter, Q1 in the United States. So if you have record low unemployment, manufacturing bottoming, housing bottoming, what's going to create the dynamic for a big leg down? I think the onus is on the bears.
Very good points. Very good points. All right, so let's move on to politics. And I like how you do this, the three C's of COVID, climate, and conflict. Now, listen, politics is always a hot topic every single month, it seems like. And it just seems like there's a lot more going on right now. Run us through what you're seeing in politics in the last month.
Well, it is those three C's driving things, right? You have the about face in COVID in China. You have the focus in the U.S. on implementation of the big three pieces of legislation that President Biden was able to pass in the first 2 years, right? The CHIPS Act, the Infrastructure Act, and the Inflation Reduction Act. Those things have now been passed. And so again, we're moving a key point. We're moving from political talking points to implementation, right? To money being spent. And the line we like from I can't actually remember where I read it, but, and we have a good chart in it, at chart 13, public spending to crowd in, or public investment to crowd in private capital. And it's interesting, that chart, if you look at it, you'll see that over the next 5 years, government spending in the US is likely to be at levels last seen in World War II. And the bulk of that money is going to be dedicated towards climate, infrastructure, and the CHIPS Act, which is bringing back semiconductor production onto the United States. And so the investment spending, which is going to crowd in private capital as well, is going to drive the US and global economy. So we're very constructive on what we call a global capex boom to deal with these issues. And we think President Biden and the European leadership, in the same vein, are going to be doing a lot of ribbon cutting over the next couple of years as these projects are fulfilled and open across the United States, as well as across Europe. And then in Asia, there's a lot of talk about President Xi being, less popular, being weak, et cetera, and we disagree with that point of view and expect that as a domestic demand-led economic recovery unfolds in China, and we think it is unfolding as we speak, that President Xi will be popular. Economic growth always drives political popularity, and we don't think China's going to be any different.
Okay, well, let's move on to policy. And obviously, it's been a little bit of the word pivot sort of has been removed from journalists' autocorrect in their dictionaries of late. What are you seeing on the policy side? Because you're still hinting towards we're going to see a pause mid-year. What do you think that means to the rest of the world?
Yeah, I'm just taking a quick look at my executive summary, which will go out shortly to our clients. Policy, we think there are huge changes going on policy-wise across the globe, right?
Yeah.
We talk about the end of the most aggressive rate tightening cycle in 40 years, right? We think we're coming to the end of that. And we have a great chart 15, showing exactly that, how the number of rate hikes are rolling over already as we speak. Then you can talk about the return of industrial policy to the United States, right? The CHIPS Act, the Infrastructure Act, the Inflation Reduction Act, all three of them together, as I just pointed out with the spending at World War II levels, the US government has not been this active in the economy in, 80 years? So, this is big stuff. And then you talk about Japan returning to nuclear power after the Fukushima example, and China shifting from full-bore COVID control to zero on COVID in the space of a couple of months is another massive policy shift. And we think the Chinese are going to double down on that policy shift by really driving this next growth cycle through domestic consumption, as opposed to either exporting or fixed asset investing. So we see in the first one, the end of the rate tightening cycle. We think the Fed will go on pause by the middle of the year and then hold. We don't see rate cuts. We think the ECB will follow shortly thereafter. They have a little bit more to do than the Fed, and that's going to support the euro, weaken the dollar, which is very important to non-U.S. equities, commodities, etc. We think the BOJ is going to try to move off of yield curve control by the end of the year. We think that's really, really big. JGB bond, bear market, domestic allocation into equities. And we think as the Fed pauses, that the emerging markets will start the next cycle, which is a rate cutting cycle. So we expect as we exit this year, and again, markets are forward looking, right? We should be thinking about the end of the year, and starting in a couple of months, by the time spring comes, you need to start thinking about the year ahead. And as we exit 2023, we think we will see the beginning of a rate cutting cycle, which will kind of seed or support a new global growth cycle that China is jumpstarting as we speak, and which will be underpinned by that global capex boom to deal with the 3 C's of COVID, climate, and conflict that we've been talking about, I don't know, like almost probably a year at this point. We've been talking about exactly this. And importantly, for folks to understand, it's starting to play out, right? So at TPW Advisory, we tend to try and really push our thinking forward into the future, and then position ourselves as we gain conviction, position ourselves heavier and heavier into the segments of the market that we think are most or are the biggest beneficiaries.
Well, that leads us perfectly into markets, right? Like, where are the opportunities sitting inside the markets right now? Like, you talk about the ETF side, but there's got to be some nice, juicy ETFs to have a look at, that's for sure.
And should you wish to hear what those are?
I do.
Clients at Pelosky, at tpwadvisory.com. Sorry, buddy. Those particular little juicy ETFs are for clients, right? I mean,
okay.
They got to get something for it. But what we can talk about here is we do think this new policy mix, which we talked about, those huge changes in policy, are going to favor the losers of the past decade, not the winners, right? The winners since the bottom in 2009 were U.S. equities, U.S. big cap growth, U.S. dollar, U.S. treasuries, etc. We think that game is over. So we think the losers of the last decade will be the winners as we move into a new growth cycle. So value versus growth, non-U.S. versus U.S., EM versus DM, physical versus digital, commodities versus fixed income. That's kind of the thrust of our thinking and our positioning. As I noted at the top, we see the dash for cash as a mistake. We see the year of the bond call. Remember, like not even 2 months ago, a number of big investment banks came out saying this was the year for the bond, right? We had this huge oversold. People were thinking we're going to have a recession, so bonds were going to be a great place to be. We disagree. No recession, no rate cuts, limited upside for bonds. So one can earn 5% in cash, but what else could you do with that money is the way we look at it at TPW Advisory. And so we see banks around the world as our preferred way to play the end of the zero interest rate policy. And we noted specifically in our monthly the example of the European banks. So here's one ETF for you, my friend, only because you're a buddy. EUFN, which is the European financials, right? Over the last 3 months, rates have spiked up in Europe, much as they have in the United States. But what spiked up even more is EUFN, up 17% over the last 3 months. And that's versus cash up less than 1% over the same time period. So we really see Europe as leading the non-US breakout. And we have a great chart on page 5 showing that. We see industrials leading the sectoral breakout, and that reinforces our conviction on the global capex boom. We have a nice chart 18, showing that. On a geographic basis, we continue to really focus on Asia. We were very focused on Europe a year ago. We still like it. We're still overweight, but our focus has now shifted to Asia. And we look both at Japan and at China. In Japan, we expect yield curve control to go as the Bank of Japan takes on a new governor. We think that means a bear market for JGBs and a bull market for stocks, particularly Japanese banks. We expect a huge reallocation out of fixed income in Japan back into equities. We expect the same domestic allocation shift in China, but in this case, it's away from property to equities. And we noted in our piece that UBS had just come out suggesting that of the excess savings that China has, now anywhere from $1 trillion to $3 to $5 trillion, we've seen references, much as we had in the US and in Europe, right? With COVID lockdown, people saved money. Now they spend it. Okay, the expectations are that as much as 6% of that money, and this is UBS, not TBW, but 6% of this money could be put into domestic equities in China. So we continue to be constructive on the allocation shift within China. We showed with a couple of charts, I don't have the numbers right in front of me, but several charts in the monthly about how the property market in China is bottoming. Property market bottoms, consumers feel better, start to spend more, drive the economy. So we are overweight both Japan and China. And we continue to be underweight fixed income. We like credit. We like high yield, particularly in Asia. And we also are significantly overweight in commodities across the complex, right? I mean, given our view, global capex boom, new global growth cycle, obviously you have to be bullish commodities, and we are. And last but not least, certainly, is we do expect the dollar to resume its weakening trend as the Fed goes on hold and the rest of the world starts to drive that new global growth cycle. So the dollar weakness, a U.S. equity market that is probably going to be fine, plus or minus 5 or 10%. We call it a flattish year. That's our view, mostly because of the weight of big cap tech. If rates don't come down, big cap tech can't really do very much in the U.S. And therefore, that flattish year in a weak dollar are perfect for non-U.S. equities to outperform. It's the best environment possible for non-U.S. equities. And that's where we're overweight non-U.S. equity. That's probably the biggest single kind of allocation call we have for this year, overweight non-U.S. equity.
All right, Jake, thanks so much for this. But just as a reminder for the viewers, where can they sign up for your musings?
I'll put down my cup for that one, my friend. Yes, the musings and the monthly and much, much more are available at Pelosky.com, Pelosky.com. And you can also find there our models. We have 2 model portfolios that we provide to clients. One is a global multi-asset, looks at stocks, bonds, currencies, and commodities. And the other is our TBW 20, which is 20 specific ETFs focused on thematic investing. And no surprise from what you've heard here, a full 40% of that thematic portfolio is dedicated to climate.
Jay, thank you so much again for your time. And I hope the investors love this. It's a great little breakdown, and it's breaking up the difference between short-term and long-term investing. Very educational for people.
Thank you, my friend.
Have a great weekend, and we'll be talking to you next week.
Indeed.
For everyone else watching, good luck investing.